All right, let's get started with the first conversation of the day. And that has to do with a certain type of loans. Now, you're familiar with credit card loans, you're familiar with personal finance loans, housing loans, but chances are that you haven't come across loans against mutual funds. Let's talk about when you should take this and what are the rules that govern it. Santosh Navlani, the Chief Operating Officer of ET Money, is joining me now. Good evening to you, Santosh, and thanks so much, as always, for taking the time. Let's talk about when such a loan would be useful, and then we'll get into the what of it.
Hey Alex, hi. So as you rightly said, most people are not aware about this category of loans, which is loans against mutual funds, and it can actually help you a lot in certain situations, like what we are in at present, where in equity markets have almost taken a beating of close to 15% from the all-time highs, and a lot of stocks are actually down to upwards of 20, 25, 30%. So a lot of investor wealth has been notionally eroded as of now. And if somebody strikes an emergency at this point of time, and maybe it health or some kind of unplanned expenditure has come, for people like that in that zone, it becomes quite difficult to sell the investments at the losses just to fulfill that unplanned expenditure or any kind of emergency one is in. And at that juncture, the loan against mutual funds can be quite handy access or source of capital for people without selling, without need of selling the investments at a loss, and continue to actually stay invested, build on the compounding as further gains come in or losses get kind of recovered completely. So one may not need to sell investment at a loss or not interrupt the long-term financial planning or goal planning of one's investments, and actually can access this source of capital, which is loan against mutual funds. So it's quite handy for people in all sorts of situations, but I think it becomes much more relevant in today's times than any other.
Let's talk about how this works then. First of all, how do you come across these loans? Where do you find them? Who offers them? And how do they work?
Yeah, so almost all private sector, public sector banks as well as NBFCs do have an offering of a loan against some kind of collateral, and most of these companies may also have the collateral in the form of mutual fund units. So it's basically nothing but a securitized, or rather, a more of a secure loan as called in banking parlance, because there is a collateral attached to it. So you would be able to find it in most of the kind of private sector, public sector, NBFCs as well. And how it works is it's quite kind of simpler, Alex. The way the collateral works depends on what kind of units or what kind of category of funds these units belong to. So if you're somebody who is holding a lot of equity assets, don't want to really compromise on selling them at this juncture and incurring a loss, you actually can approach any of these institutions and kind of access this loan against mutual funds. And what will happen is, if you are an equity mutual fund investor, then the loan to value ratio is about 50%. What loan to value ratio means is, if you give 1 lakh rupees of security in the form of mutual fund units as per the current market price, then you'll get loan of up to 50,000 rupees. If everything else, your credit score, everything is fine. So the good part about this is the loan actually is quite cheap. So typically a personal loan for a good credit score will start from about 11.5, 12.5 interest rate per annum. But for most individuals, the personal loans are in the region of 13 to 15% per annum interest. And for certain kind of individuals whose credit history has been impacted for whatever reasons, they can actually get personal loans at 24% per annum as well. So from a 24% the higher end to middle end at 13 to 15%, these loans can become the loan against mutual funds comparatively can become as cheap as average about 8 to 9 to 10% at max. And this is basically very healthy savings for individual on interest rate outgoes completely, and without affecting compounding of your investments as well. When it comes to debt investments, the loan to value ratio can be pretty high. It can be as high as 80 to 85%. That means for every 1 lakh rupees of security you would give as your units of mutual funds and debt schemes, you would actually be getting a loan of up to 85,000 rupees. So different banks have different kind of loan to value ratio eligibility criteria, but most of these banks or an institution will actually have this 50% as a rate for loan to value ratio as for equity, and 85% for debt. The third aspect about these loans is you actually continue to get dividends or any kind of benefit that mutual fund units may give in the future. Typically in case of stocks, you also get bonus or splits and things like that. In mutual fund world, the bonus is extremely rare. It has not happened many times in the past and doesn't look like it will happen, but there is possibility of splits happening. So in case your mutual funds units get splitted, they will be splitted automatically for your pledged units to the lender. And but if there is dividend payment coming in, it will hit your bank account with, so you don't have to compromise on dividend payments. And of course, your mark-to-market gains or losses continue. One thing which an individual who is borrowing money through this route has to keep in mind is the loan-to-value ratio has to always remain constant. So if, for example, you've accessed the loan by pledging your equity mutual fund units, then loan-to-value ratio will basically fall if markets correct further. So the lender will actually ask you for more collateral. That means, so if you had 2 lakh rupees of units and you got 1 lakh rupees of loan and market fell by another 10%, it becomes 90K. So, and if your loan is just begun, or your principal outstanding is about 90K at that point of time, you may be asked by the lender to actually make good for the loss of loan to value. So which will mean that either you give more units or make a principal payment immediately, so that the loan to value ratio remains constant. This is simply because the lender is taking a risk on the securities which don't have fixed guaranteed return, but actually are very volatile in nature. And for risk coverage, they would actually be asking you. So simply because, so when you're taking a loan, you should always be careful that you have don't go and maximize your loan to value ratio or other loans that you can get against your mutual fund holdings. Always keep some buffer, simply because markets can fall, especially when in equity funds. In debt funds, it may not be that bad, but don't go and maximize your loan value. Try to borrow only that you need for sure. Otherwise, it can become an unnecessary drain on your future outgo in terms of principal, penalties, and things like that.
Okay, so I think you've explained it quite comprehensively, but I do want to stress on the loan to value because I think it's important for people to understand. They're probably wondering why there's a difference between equity and debt, but there's a third asset class, and they're probably familiar with this in the form of mortgages, right? And you're talking about housing loans, and you have loan to value even there. And most people don't consider that their house is collateral, but that is essentially the case. If you don't repay your loan, your house is effectively what the bank will take possession of. Can you explain this in a very simple manner?
Yeah, so you're so right, Alex. I think most people don't realize that all the home loans in the country are actually mortgaged. That means collateralized against the loan that you have taken. We don't realize it because it is so normal to take a home loan, but it is not normal to take a loan against mere mutual fund units. The reason if you look at real estate, it works a bit differently. Where when you take a loan, typically as per RBI regulations, the customer has to bring in 20% minimum equity on his on his or her own. Basically, if you're buying or taking a loan of buying a flat of about say 1 crore and you want to maximize your loan, then first 20 lakh rupees has to be kind of given by you, and you will be maximum eligible for 80 lakh rupees. You may not even get that, but you will be maximum eligibility will be that. So I think it works a bit differently on real estate. It doesn't work like in the way that you are supposed to give collateral, because you're just buying the home and the collateral may not be completely on name. Many states have different rules where some states actually ask for registration of property in your name, and only then they give the loan to you. Whereas in certain states, it doesn't work like that, where you basically are booking a flat or an apartment, and just because of that confirmation, the bank may be giving you some kind of mortgage facility. So it's a bit different there, though the commonality is basically collateral in the form of real estate, land, apartment, or collateral in the form of mutual fund units. There is also gold loans. Many people have probably heard about that, where you mortgage or you basically collateralized your gold, physical gold or digital gold, or not digital gold is not yet available, but there are a lot of talks that digital gold may be available as a collateral soon. But for now, it is physical gold, or you can actually also mortgage or collateralize your gold fund units or ETFs for that matter. So you can collateralize that. You can actually give that and take access to capital in the form of a loan against mutual funds or a loan against securities in that sense.
Santosh, we've discussed the broad loan to value ratio for debt mutual funds and for equity mutual funds. But it's clear that not all equity mutual funds are created equal. So therefore, is there a certain amount of preference, if you can call it that, from the lender's perspective? Will somebody, for example, with a particular mutual fund scheme find that the answer is no from a lender when they're offering this as collateral?
Yeah, that's pretty much possible, Alex. So as of now, most banks actually have listed. So if you go to the lenders that you are interested in on their website, you may find all the information. So some of the lenders, be it private sector, public sector, may have listed that they would only be accepting no mutual fund units as collateral only from certain mutual fund companies, and that too specific schemes. So I guess most basically lenders allow collateral from about top 20 mutual fund companies. So there are about 40 odd mutual fund companies in the country today. So 20, if you are one of them, you may not be getting a loan. But given that most people have at least some kind of investments in top 10, top 15 mutual fund houses or AMC products, I don't think this is a very big concern. But yes, if you are somebody who's actually investing in NFOs or investing in schemes or funds which would have very strong track record, and they've not been shortlisted because their track record is pretty good as per the lender, then you may face trouble in terms of getting qualified for the loan against your existing schemes. So one should not, though I would actually say that one should not go and search or invest in only schemes which are accepted by lenders, because that you actually take a loan when it is not a good time for you. You don't really mortgage anything in life unless there is a need to do that. So I wouldn't really say that you should keep that in mind. But yeah, when you approach a lender, the lender may actually have only certain part of your portfolio being qualified as collateral, and some part may be rejected by them. And it will affect your loan to value ratio correspondingly.
Certainly. And what about the the level of the interest rate that is charged? You mentioned the range, but like any other loan that is given out, is it that a certain type of institution will give you a better rate?
So PSU banks always are known for cheaper interest rates, and some of the banks actually offer as low as 7.5% interest rate. So PSU banks will typically be cheaper. I think most private sector banks are in the region of 7.58 to 10% kind of interest rate. But NBFCs may be a bit expensive. Most NBFCs will charge you upwards of 12, 13%. Typically, but NBFCs will also charge you higher personal loans, as a matter of fact. So relatively, any lender who is offering a personal loan which is not secure, and there's no collateral being asked by the lender, be it a PSU, be it a private, be it a NBFC, they will be charging higher rates for their personal loan products, and correspondingly they will be charging lower interest rates compared to them for their own loan against mutual funds offering. So it's just basically risk management principle there. But yeah, PSU and private sector banks may be cheaper source for anybody in the country today.
Talk about the quantum and the duration, because those are the two key factors apart from the rate that you're looking at very closely. We've discussed the collateral, but how much can you borrow, and what is the tenor, as they say, of the loan that you can take?
So I guess most banks typically have minimum loan sizes for any kind of personal product. I think most banks actually offer the loans only if you are taking 50,000 rupees and above. So and minimum loan tenure is at least 1 year. So if you are borrowing less than that, the bank may not be interested in offering a loan. So 50K or typically even 1 lakh rupees is a larger norm as a minimum loan amount, and minimum loan tenure is 1 year. There is some caveat one keeps in mind is when you're borrowing against equity mutual fund as a collateral, then the max loan that you are eligible for is 20 lakh rupees, irrespective of the collateral that you are willing to bring. So if you are somebody having a higher equity mutual fund portfolio, like upwards of 50 lakh rupees, a current market price of, or even a crore, chances are very high that you will not be getting a loan beyond 20 lakh rupees on your units. In that case, basically the bank is wanting to restrict its exposure in equity markets, simply because if the markets fall by a larger value, the customer may not be willing to provide more units as collateral, or may not be able to pay a part of the principal just to maintain the loan to value ratio that the lender prefers. On the debt side, because debt typically is no large mark to market gains, most banks actually allow you to borrow without any limits, and the limits may not be brought in till the time loan values actually approach even a couple of crores. But personal loans of this nature, of a crore or a crore plus, are something which is not a very normal thing in the today's world, to be able to afford a 1 crore loan, and afford an EMI on top of it. It's quite rare. So I think these source of loan is far better than actually taking a personal loan or a credit card loan, for sure. But it is not something that just because it is available, one would go and start borrowing it. Remember, as I mentioned in the beginning, that uh, go and take the loan which is required to fulfill the emergency or unplanned expenditure, and not really maximize the loan, because if you take that loan, you may end up spending that money into things which may not be things that you want at this point of time, or you may need at point of time.
I think we've had a comprehensive conversation, as we usually do. Santosh, thank you so much for taking the time. Appreciate it.
Thanks.